So you're wondering what in the world is a cap rate, why the word cap, and what does it mean? And how do you even calculate a capitalization rate? Cap rates are the basis for all real estate investments really, and kind of the common language that people use to discuss different properties and compare whether they should buy this duplex over here by the beach or this quadplex over here by the city. Now I know some of you might already be familiar with this, and this is just a bit of a refresher and expanding a bit more on it, but I want to make sure people understand this from a basic level too. So simply put, the cap rate or capitalization rate is calculated by taking the net operating income or NOI and dividing that by price, and that gives you a percentage, which is your cap rate. So let's give an example here. Let's imagine you're looking at a 10plex and the net operating income or NOI is $100,000 per year. If the owner, or the seller, is asking for a purchase price of $2 million, then you would take $100,000 divided by the $2 million, and that would give you 5% cap rate, which some people would just call 5 cap. Now here's where it gets interesting though. You might kind of deduce that, okay, so basically higher cap rate, better property, better investment. I just want the highest cap rate possible. And maybe you do. Cap rate is kind of also like it's a bit similar to cash flow in the sense of the higher the cap rate, the more money you are making on the property and versus the purchase price. And so properties that are in maybe like a not so nice area of a ghetto is going to have a higher cap rate, right? Higher cash flow versus maybe not so high of appreciation. So the higher the cap rate, sometimes in some areas you have lower appreciation. So it depends on investor preferences, right? If you buy a nice duplex by the beach, you could expect a lower cap rate versus maybe buying a duplex outside of the city in a not so nice area because the price of it's fairly low. You're still getting decently high rents, so you end up having a higher cap rate. And again, this now is where we take cap rate and we mix it with your investment preference. Do you prefer having something in a higher appreciation area where you are going to be, let's say, in A, B neighborhood and have A, B tenants? Maybe lower turnover, less headache, you're not worrying about the property as much, that sort of thing, which also kind of plays into a lot of people who are maybe not local here and they just want something that's a bit more hands-off. Or do you want something that's a little bit more in a rough and tumble area that you're going to have higher turnover, maybe higher tenant issues? Again, it's not always the case, these are just generalities, but have a higher rate of return in terms of that cap rate, right? You're just going to have a lower appreciation, most likely, because the area is not as nice, so it takes longer for it to get nicer. Another way some people think of cap rates is a higher cap rate, so a higher rate of return, similar to like equities markets, basically means that there's a higher risk. So we'll give you a higher return because there's a higher risk for this property. Maybe also a higher headache, a headache rate. You get a better rate of return, the more headache you're willing to deal with, versus a lower cap rate, lower rate of return, lower risk. So that's why you're not going to get as much of a return as a high of a cap rate. Lower risk, lower headache, lower cap rate. One more thing on cap rates before I make one more point on appreciation, which is a very important one too to consider when you're thinking about investing and understanding investing, is that one exit strategy and method that people do use too with these cap rates and stuff is they look for properties that have an artificially low cap rate because the rents are outdated or there's some simple value add improvements that you can make to a property that will dramatically increase the rents, or at least if 10% is a lot, 20% is a lot, and all of a sudden, let's just say investment properties in that area are selling at a 6 cap. If you can buy something that you could easily raise, the rents and everything to, then you could be in a spot where you buy something, you make those value add improvements, you raise the rents, maybe you kick the old tenants out, you get people in there that are willing to pay, top dollar market rate, And all of a sudden, you kind of flip and turn the property, you hand it to another investor who, let's just say they're happy with a 6 cap, but now that 6 cap, you bought it at 500,000 and the 6 cap at 500,000 was because the tenants were only paying, and let's just say for numbers purposes, $1,000 per month. And now you're getting the tenants to pay $1,250. And let's just say that 6 cap now brings the price to $700,000, right? All of a sudden, that's where you kind of have that value add. And the second investor might be okay with it because he's still making a 6 cap. It's just since you've had that value add and brought those rents up and added that value add into the building, now he's able to make a 6 cap and pay $700,000 for it. So that's other kind of one strategy or way to think about it too. But from a cap rate standpoint is also on the exit strategy, right? In terms of, okay, if I enter here, is there an exit strategy and what's the going cap rate in the area? All right, now going back to appreciation real quick, I definitely have a lot of investor clients who feel strongly about the fact that the money they make is through appreciation when it comes to true wealth building. It's not through cash flow. So yes, cash flow is great, and yes, cash flow is inevitable over time with appreciation and rising in prices, while their mortgages and stuff remain relatively the same other than some increasing taxes. But the real wealth that they're building is through the overall increase in valuation of their portfolio. So the rental property that they own, it's about the appreciation that it is getting, not as much about the cash flow. So for those looking to build long-term wealth, again, you might want to focus more so on the appreciation, which gets down to a lot of it is location, versus just going for the cash flow. And it also might save you from some of those extra headaches and some of those extra risks, because like we just discussed, higher cash flow, higher cap rate, higher risk, higher headache. Well, there you go. There's a lot to consider there. That is a quick introduction to cap rates, some of the different angles to think about it and how it applies to buying, investing, and selling. But if you have any other questions about it, drop a comment below. Let me know, what's your experience with cap rates? What do you look for? What else do you think is really important about them and how you apply it to investing? And where you prefer to land on the spectrum. Do you think it makes more sense to just go for that cash flow, go for that high cap rate, or do you prefer to have a little bit of a middle ground, or do you prefer to go all for appreciation and just kind of bite the bullet on a lower cap rate and lower cash flow for that long-term appreciation? So drop a comment below and let me know what route you think is best. And as always, if you're thinking about anything in Florida, especially in the Tampa area where we specialize, myself and my team, the OBS Group, would love the opportunity to earn your trust in business. So call, text, or email me, give us a shout, and I'd love to connect. If you like this clip and want to watch another one, go ahead and click here. And if you want to make my day, smash that like button, drop a comment below, let me know your thoughts, and don't forget to subscribe. Hit that notifications bell so you don't miss out on the next video we drop.